Howdy, Jacob here. Today we're looking at Aerovironment in the aerospace and defense industry. 5.6 billion market cap on 5.5 billion enterprise value. They design, develop, produce, deliver, and support a portfolio of robotic systems and related services for government agencies and businesses in the U.S. and internationally. You're looking at pretty impressive growth here. I'm probably seeing a 12% CAGR over the last 10 years. Return on invested capital is low, however, so likely their best form of handing money back to the shareholders would be dividends or share repurchases. But gross margin, not too bad. Operating margin, been negative recently. Let's see if that's a lot of R&D, though. So a little bit R&D, and it has been growing quite a bit. So the R&D is more than triple what it was 10 years ago. But still, it looks like there's also this other non-operating income write-offs that are hitting the company's net income and making it quite negative. But I don't see a huge increase in shares, so we'll see whether the free cash flow statement agrees with that. But first, the balance sheet: 133 million cash on hand, with 8 million short-term debt, 126 million long-term debt. So almost enough to write off all their short-term and long-term debt. So we're really not concerned about that balance sheet. Capital expenditures are growing due to acquisitions, it looks like, because reinvestment is pretty minor. And really, acquisition is the use of their free cash flow. Issued quite a bit of shares over here. They brought down debt a bit as well. But yeah, not a lot of, they're not buying back shares and they're not issuing dividends. So looks like, at least with their historical use of free cash flow, you're just going to get price appreciation. So let's make some assumptions here on the revenue growth side. You're looking at big growth. Can they keep that going? They do make acquisitions, so it might not be entirely organic growth, but I think 10 makes sense to me. There's just not a huge return. I don't know how I'm seeing growth ahead of them, and then return on invested capital is very poor. So I think I'm pretty comfortable going with just market average. I think growth will be better than normal at the end of 7 years, but I think that the ability to give the shareholders return might not be. Probably just let's do a little bit lower than average since they've been negative the last couple of years. Share change. Stock-based compensation, 16 million in aggregate, which is it's really not a lot. Let's just say nothing, negligible. So we do have big growth here, but unless they can get the double-digit margins here with this much growth, I just don't see it. This is a 93% drop to get to the price that we're looking for here. So to me, maybe there's something I'm missing, but to me, it's not so obvious where I'm just going to be pouncing at it and needing to do more research. It just looks quite a bit expensive on my end. So hopefully you enjoy the video. Have a good rest of your day. Thank you.